Hi, my name is Christian Waldegrave, market analyst at Teekay, and I'm here on the bridge of the Nassau Spirit to give an update on the conventional tanker market for April 2012. Now, the last few weeks have been quite interesting in the tanker market, particularly in the bigger ships, the Suezmaxes and the VLCCs in particular. In fact, VLCC rates have been at their highest in 18 months at around $45,000 to $50,000 per day, and that's due to a couple of things. Firstly, OPEC oil production has been very high in recent weeks. In fact, it's the highest in 3.5 years. And that's for a couple of things. Firstly, we've seen some production outages in non-OPEC countries, such as Sudan and Syria for geopolitical reasons, but also in the North Sea and Canada, where we've seen some unplanned outages. Secondly, what we've seen in the last few weeks is very strong demand from Asia, and in particular China. In fact, in February we saw Chinese crude imports of over 6 million barrels a day for the first time. And what's happening there is that domestic consumption is strong, but also we've seen that China has been doing some stock building. They're just completing the second stage of their strategic petroleum reserves, and so they've been importing extra oil to fill that. So that's been adding to tanker demand. What's also been happening in Asia is that some countries such as Japan and China have been importing less crude from Iran, and they've been looking for alternative sources of crude supply. And that's meant that they've been importing a lot more from places like West Africa. In fact, imports of West African crude into Asia during the first quarter were the highest they've ever been. So that's all positive for tanker ton-mile demand, and that's what's given some support to VLCC rates. Now, some of that strength in VLCC rates has trickled down somewhat to the Suezmax sector. Suezmax earnings averaged about $25,000 per day during March, and that's because we had a very strong VLCC market out of the Middle East, and so there was less competition in West Africa on the Suezmaxes, which meant they enjoyed slightly stronger earnings. However, those earnings have now started to just fall down somewhat into April, and that's because we're moving now into a period of refinery maintenance when oil demand and therefore tanker demand is slightly weaker. Also on the Aframaxes, we haven't seen so much of the impact of higher OPEC oil production, and that's because Aframaxes don't tend to see the same benefits from OPEC oil production that the VLCCs do. Aframax rates are much more influenced by regional factors. And what we saw in the first quarter was that some seasonal factors such as weather delays and heating demand gave a boost to Aframax rates. Those seasonal factors are now tailing away as we move into spring, and so Aframax rates averaged about $15,000 per day during March, and then into the early part of April they've fallen into about the low teens. Now, looking forward to Q2, as I said, we are now moving into the period of refinery maintenance. In fact, we're probably just past the peak of maintenance in the US and Europe, but refineries in the Far East are now going into their peak maintenance season during April and May. So that means less demand for crude oil and therefore lower demand for tankers. And that's a normal seasonal factor that we often see. And for that reason, crude tanker rates normally dip during the second quarter, carrying on into the third quarter. But we do expect, as we said in previous updates, the rates will improve towards the end of the year as oil demand improves on the back of a stronger global economy. So that's our tanker market update for April, and tune in again next month for our next update.